Welcome to the deep dive. We've pulled together quite a stack of fresh market intelligence today, and it's all centered on probably the biggest policy move we've seen in months, the Fed's recent interest rate decision.
Exactly. And that decision, it wasn't just, a technical tweak. It feels like a really profound shift in what they're prioritizing. So today we're going to put the why behind that Fed action right alongside the latest global market stats. This is data up to September 2025. We want to show you precisely why they move now and what the global economy seems to be signaling back.
Right. So our mission for this deep dive is pretty straightforward. Unpack why the Fed made its first rate cut since, December 2024, and then connect that move to what the global markets, equities, bonds, commodities are actually telling us right now. You should walk away from this knowing exactly how the landscape has, shifted. Okay, let's get into it. The Federal Reserve just lowered the federal funds target rate, 25 basis points. That brings it down into the 4 to 4.25% range. Now, for the past year, the Fed's message was just singular, beat inflation. Right. So this cut feels pretty significant because it suggests, either that mission's done or maybe more interestingly, something else took priority.
Yeah, what's fascinating is just the speed and the clarity of this policy change. The Fed spent so much time telling markets they'd be higher for longer to really stamp out that inflation. This rate cut, it's a definitive signal of focus has moved. They're not primarily worried about inflation risk anymore. They seem to be prioritizing growth and, maybe most importantly, employment.
That really is the core takeaway, isn't it? The world's most powerful central bank just swapped its primary focus. So why the sudden reversal? I mean, did they just get a load of gloomy forecasts? Or was it specific data, something surprising that really forced their hand?
It was definitely driven by some surprising data revisions we saw in the source material. The first shock was the employment picture. Recent updates showed job growth had been much softer than they first thought. And this wasn't just a slowdown. It was like evidence the job market was maybe less robust than they believed months ago. That introduces pretty significant downside risks to jobs, risks that they felt needed addressing, now.
That sounds like a classic Fed fear, right? The idea the economy is slowing faster than the dashboard is showing.
Precisely. And the second piece of data that maybe gave them cover to cut was on the inflation side. The feared cost pressure from tariffs, the tariff pass-through hitting consumer prices. It turned out to be, more modest than the Fed had modeled. It seems businesses absorbed more of those costs than expected, kind of shielding consumers.
Okay, so the whole calculation changed. They saw weaker job numbers needing attention, and the inflation threat may be easing a bit faster than they thought. The balance just tipped hard towards protecting jobs. But hang on, this wasn't unanimous, was it? The vote itself tells a story.
It really does. While the 25 basis point cut got the majority vote, it wasn't unanimous. Governor Stephen Miron actually dissented. He wanted a bigger cut, a half-point rate cut. And that detail is crucial because it signals some pretty deep internal disagreement about how serious the job situation might be.
Wait a second. So if the Fed just pivoted to prioritizing jobs and one governor wanted to cut twice as much immediately, it suggests he thinks the pace is wrong. Like he believes the employment risk is way more severe than the main group admits. That sounds like some deep worry.
It definitely raises a critical question about, the economic model they're relying on. If one governor feels 25 basis points is just symbolic, he's essentially saying the economy might already be in real trouble and needs aggressive help now.
Yeah.
Which leads us right into the market reaction, because that same kind of worry seems reflected in how traders are betting on what happens next.
Right. Which brings us to that classic test of confidence, the gap between the official plan and what the market actually believes. You've got the Fed's own projections, and then you have the markets putting billions down on what they think the Fed has to do. How big is that gap now?
It's pretty substantial, and it says a lot about the skepticism towards the Fed's sort of cautious stance right now. We can measure this by looking at market pricing for future rates versus the FOMC's own dot plot projections.
Okay, maybe for listeners newer to this, what exactly is the dot plot?
Sure. It's basically a chart the Fed puts out quarterly. Each FOMC member anonymously puts a dot showing where they think the federal funds rate should be at the end of the next few years. It's their kind of official collective forecast for policy path.
Got it. And what does that official path look like compared to what the market, the street, expects?
Well, right now, the markets are pricing in an extra 50 basis points or so of rate cuts in 2026. That extra 0.5% of easing is relative to what the FOMC's latest dot plot expects. So essentially, the market thinks the Fed is either underplaying the current weakness or maybe overestimating how long they can resist cutting rates next year.
Wow. So the market isn't just nodding along saying, okay, 25 points sounds good. The market's basically shouting back, this cut proves things are weaker than you're letting on, and we bet you'll have to cut way more, maybe 4 or 5 times next year. That's a huge difference in outlook.
It absolutely is. The market is significantly more optimistic, you could say, about continued rate easing next year than the Fed itself is signaling. It's betting that the jobs data that spooked Governor Mirren into wanting that half-point cut,
Yeah.
that's going to become undeniable evidence. Evidence that forces the whole committee to cut faster in 2026.
That clarity on future expectations is really fascinating. Okay, let's pivot now to the immediate reaction. Looking at last week's market stats, the sort of initial fallout from the cut, what really jumps out as the first sign of how investors reacted?
Well, the reaction was pretty much a classic risk-on move. Even though the cut was rooted in some fear about jobs, investors just focused on the easier money part. The equity numbers are clear. MSCI AC World was up 1.0%, S&P 500 gained a solid 1.2% for the week. Investors see cheaper money coming, and, well, that's usually rocket fuel for stocks.
And if we look under the hood at the sectors, you can see exactly where that excitement went. It definitely wasn't into the safe, boring stuff.
No, absolutely not. The biggest winners for the week were decisively in those sectors really sensitive to long-term growth hopes. Tech was up 2.5%. Communication services gained 2.4%. It just shows this renewed, pretty strong appetite for growth stocks. They collectively smashed value stocks last week.
And that's the sort of contradiction we need to flag for you, the listener. The Fed cuts rates because jobs look soft, growth might be at risk, yet the market pours cash into the most speculative, high-growth stocks. It's like they're betting on a perfect soft landing followed by a huge reacceleration, all powered by those expected future rate cuts.
The classic read of the Fed put, isn't it? That idea the central bank will always step in to save markets. The second the Fed signaled they care more about growth than inflation right now, investors just piled into the names that love low rates.
Okay, let's switch over to fixed income. This is where things can sometimes feel a bit counterintuitive. Normally, a rate cut means bond prices go up, yields go down. But what happened with the U.S. 10-year yield after this announcement?
Yeah, you're right. It's interesting. The U.S. 10-year yield actually rose 6 basis points, settling around 4.13%. Now, this seems counterintuitive, but only really on the surface. While the Fed cut the short-term rate, the market read the move as a signal that maybe the economy will avoid a deep recession and perhaps even pick up speed in 2026 because of this stimulus. So, higher long-term yields can reflect hopes for stronger future growth, or perhaps a belief the Fed might have to stop cutting sooner than the market currently bets.
So rising yields here could actually suggest the market thinks the Fed's move will work in boosting growth, even if the reason for the cut was weakness.
Exactly. And the signal we got from credit markets really backs up that risk-on feeling. Global high-yield spreads, that's the extra interest investors demand to hold risky company debt instead of safe government bonds, they tightened by 7 basis points, down to 295. When those spreads narrow, it means investors are suddenly much less worried about companies going bust. They're willing to take more risk for less reward. It's a big thumbs up for corporate health, essentially.
Okay, and here's where the whole market picture gets really interesting, I think. It shows the mix of fears and hopes across different assets. You look at the year-to-date numbers, particularly in commodities. Wow, gold has just been on an absolute tear.
Gold has been the real macroeconomic story this year, hasn't it? It's up an incredible 39.9% year to date. Just think about that, almost 40% growth in under 9 months.
That is just massive. What's driving that kind of aggressive move in something usually seen as a safe haven? Is it fear about policy, inflation hedge, something else?
It's probably a complex mix, but yeah, 40% growth suggests some deep, maybe structural unease. It signals a couple main things. Perhaps fear of future inflation if the Fed eases too much, or maybe more likely it reflects geopolitical uncertainty and just general skepticism about fiat currencies globally. Gold doesn't really care if the Fed pivots week to week. It often reflects those bigger, longer-term worries about global stability. Meanwhile, Brent crude oil was pretty flat last week, only up about 0.7%, so not much short-term supply worry there.
Now, zooming out again to the big macro picture, we see these huge differences globally. It really underlines why different central banks are having such different conversations. US CPI inflation is running at, 2.9%, UK is higher, 3.8%. But we have to talk about the massive outlier among the big economies.
Yeah, the clear outlier is China. They seem to be grappling with a really surprising deflationary trend. Their official consumer price index is actually negative, -0.4%. Prices are literally shrinking month on month over there.
Deflation, and when their official GDP growth is still like 4.5%, that's almost hard to compute when we're sitting here dealing with nearly 3% inflation in the US. What does that divergence mean globally?
Well, this stark difference just highlights that the U.S. is still managing risks related to, overheating and maybe labor tightness, while China's facing these deep issues with weak domestic demand, maybe oversupply. Even with that strong official GDP number, China's deflation potentially pulls global prices down a bit, acting like a sort of deflationary anchor for everyone else, even while the Fed here tries to boost U.S. growth. This policy divergence creates some pretty unique challenges for multinational companies, for global investment flows.
So, to figure out if the Fed's pivot was the right call, and if that worry about jobs is really justified, we need to know what data is coming up next. What key indicators should you, our listener, be watching this week to either confirm or challenge the Fed's new worries about jobs and consumer health?
Yeah, the upcoming data is really crucial because it tests both sides of this story, the employment risk and the inflation risk. Midweek, we get the PMIs, those purchasing managers' indices out of the Eurozone, the UK, and most importantly, the U.S. composite PMI.
And why are those PMIs so critical right now?
Well, the PMI is seen as a leading indicator for economic health. The last U.S. composite reading was pretty strong, 55.1, suggesting solid expansion. If this new number drops sharply, say, below 52 or even lower, that would really confirm the kind of underlying slowdown risk that likely spooked the Fed and, justified the rate cut in the first place. It's an immediate check on business sentiment.
And then Friday looks like the big day for the Fed's preferred inflation gauge.
Absolutely. Friday brings the really key stuff. U.S. core personal consumption expenditures, the PCE number, year over year. Last time it was 2.9%. And alongside that, we get U.S. personal income and personal spending figures. Unlike the CPI, PCE is the Fed's favorite measure. So these numbers will give us a direct read on both inflation trends and how the consumer is holding up. If income and spending look weak, it suggests that soft jobs data really is hitting consumer confidence and activity.
Okay, so let's try and pull this all together. What does it all mean? You, the listener, now have the full picture. The Fed cut 25 basis points, and it was driven largely by those surprising downward revisions to job growth data, plus maybe less fear about tariff pass-through. Their focus clearly shifted to employment health.
Right. And we can sort of summarize the core tension for you. The Fed is acting cautiously, cutting rates for the first time in ages, signaling real worry about employment risks. But conversely, the markets, especially those high-flying growth sectors like tech and communications, they're euphoric. They're pricing in much deeper cuts for 2026.
Right.
There's that clear 50 basis point gap versus what the Fed itself is forecasting. The market just sees weakness as the prelude to a flood of easy money.
Yeah, that gap and that mirror and descent we talked about, they really tell the underlying story, don't they? The Fed is worried about economic weakness, but the market's pricing in a massive stimulus-fueled boom. We learned the Fed's focus has flipped entirely to employment risk, yet the markets are betting on aggressive future cuts, which usually signals huge confidence in growth. So here's the question to leave you with. If the job market really is softer than expected, how fast will those soaring growth sectors, those expensive tech and communication stocks, start reflecting that reality? And maybe more immediately, what happens to all that market euphoria when the next round of PMIs drops later this week? Something to chew on as you look over your own sources.